Okay, now you should be seeing my screen. Thank you. Thanks, Doug, for the introduction. Indeed, today I will be talking about the money creation process in the real world and what can go wrong if we use standard money multiplier approach to understand how money creation works in the real world. So before I start, the usual disclaimer is in order. So these are my own views and not necessarily of my affiliation. And also, in addition to this usual disclaimer, I just want to have this unusual disclaimer, which is that this stunt is performed by trained professionals. So do not try this at home for those relatively uninitiated, because in other words, to say this in economics terms, what I mean here is that despite the impression that today's discussions will make, I will not be arguing that banks create money out of thin air, sometimes called creating money ex nihilo. And this is not something I want to emphasize. I just want to emphasize that the process how money creation works is different than depicted by usual standard textbooks. So even though the banks will be creating money in what I will discuss later on, still this money is not created out of nothing. Instead, it's created out of trust and demand, and this will implicitly become clear, at least I hope, at the end of the discussion. Okay, so now let's have a quick look at how the textbook approach to money creation, or what they call money supply, works. So, for example, if we take the one of the most standard textbooks, this Mankiw textbook, the way Mankiw explains this money creation or money supply is that it first tries to let the reader that let's imagine that we don't have any banks at all. And let's suppose that there is some quantity of currency in circulation. And then Mankiw introduces banks. And the idea is that those $100 are deposited in some bank. It's in the book called First National Bank. And right after this First National Bank is able to lend out. And that's what happens in the textbook. When the banks lend these reserves out, essentially they create another $90 because the assumption here is that the reserve requirements are 10%, so that this First National Bank has to keep $10 in reserves because it has deposits equal to $100. So now the textbook argues that in addition to these $100 deposits, these $90 deposits was also created when $90 of cash was actually lent out to the borrower. So now the quantity of money, the money supply, is 190. And then the depiction is that the process continues because this $90 cash will be deposited into the Second National Bank and so on. So this is essentially how money multiplier works. But of course, this is a model which obviously has some simplifications. One of the simplification, which is I would say outright wrong, is to say that there is a supply of money without any banks at all. So this is actually at odds with legal frameworks, with accounting frameworks. If we don't have banks, the only way for the central bank to supply money is essentially to do overt monetary financing, which is the lending money directly to the government, which in today's legal frameworks is prohibited. The central bank has to supply liquidity only through banks, and if there are no banks, then it's within the current framework. It's not really intuitive to assume that there is a money supply. But of course, this is not the key argument that I will be basing my discussion against this money multiplier. Of course, this is wrong. We know all models are wrong, but some are useful. So instead of emphasizing how wrong this is, the question is this model useful? And what I will be arguing today is that this depiction is not useful. It's very far from useful, and in some instances, it's actually harmful. And because it generates so many misconceptions, and this can actually lead to some serious policy errors, as well as insufficient modeling of how money is actually affecting macroeconomic environment. So instead, how does really money creation work? Well, in a nutshell, money creation works in a way that results in the same picture. For example, I'm not saying that the final end result of the money multiplier model is different. The final result can very well be the same. We can have still a bank that has $100 deposits, then the bank that has $10 reserves and $90 loans. But instead, the way we get there is different. The process, how this process works, is different. And as we will see, misunderstanding the process, even if the end result is the same, misunderstanding the process can lead to serious misconceptions. So how does this process work? The process is actually essentially, in a nutshell, a general equilibrium process. You need many different agents like banks, borrowers, fiscal sector, so that you are able to arrive at this result, which is shown on the balance sheet of the First National Bank. So this is a general equilibrium effect. So the question is this something new? Is this something that we just understood? Or is it something that economists knew all along? So actually, if you look at the previous papers, for example, from 20th century, world-renowned economists actually understood how this process works. It's probably because monetary frameworks back then was somewhat different that resulted in this money multiplier model. But now, because framework is of interest rate targeting, which is something different, that's why this interest in how money creation work in a more realistic manner has rekindled, and that's why we're discussing this today. So, like I said, this is something that economists knew. It just rekindled. For example, this is a nice quote from then governor of the Bank of Canada, which says that the way we understand monetary aggregates is not really the same as the old textbook models would depict. Then these many other papers arrived. So we have this Bank of England paper published in 2014, which essentially tries to shed some light on these misconceptions around how money creation works. For example, this code emphasizes the fact that this money multiplier is not actually how the real world works. Banks do not act simply as literal intermediaries. They do not lend out deposits that they get first. Actually, it's the other way around, that the loans and deposits are actually created together. Then we also have some IMF papers. For example, this is a paper co-authored by Doug, and this paper actually tries to incorporate this idea of endogenous money creation into a DSG model. And there as well, it's emphasized that it's extending loans that creates the deposits, bank deposits. And in this sense, banks actually expand balance sheet, which is intuitive because we know that in accounting terms, when banks extend loans, they do not simply swap cash into loans on their balance sheet. They essentially expand their balance sheet. That's how it works. And it's, again, in line with how the accounting in the current framework works. Then we can also have a look at the BI's papers, which is also underlying the importance of banks and their role in endogenous money creation, money which acts as a purchasing power. The same, for example, in Bundesbank publications, saying that the bank's ability to extend loans has nothing to do with cash or with excess reserves. It has to have in advance. It's actually loans that are creating deposits, and banks do not have to wait for in current framework, do not have to wait. The same for in case of Reserve Bank of Australia. It's emphasized that this process of extending loans, this is that creates a system-wide level. On a system-wide level, it creates deposits. Even though the deposit may be lost from one bank to another, on a system level, it's a overall loan extension. And that's why the Fed decided to start teaching these new tools in the current framework, and to make sure that the public understands how this money creation actually works, as opposed to the money multiplier, which they call an outdated concept, which I think it is. And another neat quote from Jerome Powell, which says that the way we understood monetary aggregates from the old textbook depictions is something that we have to unlearn. And that's actually, if you haven't done so yet, this is what we will try to do today, to unlearn how textbook models depict, and to see how to learn how actually it works. So to start discussing the mechanics of how money creation works actually, as opposed to money multiplier approach, it's nice to quickly review what is the nature of the banking business in a nutshell. And at the slight risk of oversimplification, let me say that banking is essentially exchanging liabilities. It's like banks create one type of liability, they sell this type of liability, which is usually liquid. It's short term, so it's informationally insensitive. It's low risk, and above all, it serves as a medium of exchange. And banks create this kind of liability, they sell it, and in exchange, buy or get another type of liability. By liability, I mean liability of others. Obviously, liability of others being on the bank's balance sheet is an asset for the bank. And this other liability is essentially illiquid. It's relatively long-term. It's high risk, but because it's profit generating, in a nutshell, it has interest rate that is higher than the interest rate on deposits. Banks are willing to do this kind of exchange of liabilities. They make profit from this exchange of liabilities. So this is essentially liquidity, maturity, and risk transformation. And this is in a way how actually money creation works, as we will see. So this is money creation because money in our contemporary monetary economies, money is essentially an IOU. And if we look at the money creation through this lens, then it's clear that banks are not traditional literal intermediaries, even though they do some intermediation. Its intermediation is in a sense of like I said, liquidity, maturity, and risk transformation. And again, understanding how this works, then it's also clear that the true price of intermediation that can be done by, for example, non-banks as well, it's like a loan rate, the difference, it's approximately related to loan difference between loan rates and like term deposit rates or something similar. But the difference between those term deposit rates and current account deposit rates is essentially a seigniorage. Seigniorage, something that the textbooks teach that it's the central bank variable, but not only. As we will see, because banks are able to create these kind of liabilities, which are liquid, short-term, low risk, and they act as a medium of exchange, people are willing to accept low interest rates on this. So this is in some sense convenience yield. And because this convenience yield is something that lets banks pay less interest on current account deposits, it's essentially their profit from creating money. So that's why I call this seigniorage. So this is in a nutshell how the banking works in a simplified picture. And if we look at this through this kind of perspective, then it will be easier to understand how money creation mechanics work. And this money creation mechanics is well described by the Bank of England paper, which shows imaginary balance sheets of households and banks. For example, here we have balance sheets of a house buyer, which is willing to buy a house from house seller, but because house buyer does not have funds, money in advance, it has to borrow. And there are a couple of banks for each of a buyer and the seller. And what the buyer would do in this Bank of England paper is it would take out a loan from the buyer's bank, and what this results in is essentially an expansion of balance sheets for both house buyer as well as buyer's bank. And this balance sheet expansion is actually a mirror image, so that the new deposit that is created by new loan is an asset for the house buyer, but this new deposit created by this loan extension is a liability for the buyer. So on the net financial asset may not change, but because the gross positions expand, that's what's creating money. And of course, then the house buyer would transfer these deposits to house seller, and this is the way we essentially, for example, buy house. So like we don't carry suitcases full of cash to buy houses. We just transfer those deposits. And of course, these transfer deposits would require some reserves. And if banks use those reserves to transfer those deposits from one bank to another, then the bank that was obliged to transfer those deposits to another bank would lose some reserves, but the seller's bank would get those reserves. And then we can have this interbank market where these buyer's bank and seller's bank can settle and smooth out this allocation of reserves. Anyway, even if this interbank market is not sufficient, then buyer's bank can actually go to central bank and obtain liquidity, because we know that central banks will be willing to supply liquidity to make sure that interbank interest rates remain close to the policy rate. So in a sense, here we see that the money was created. This new deposit is in the system, even though the central bank itself did not explicitly do something at the start of this process. So this is something we will generalize a bit later. Another type of example or mechanics how money may be created is something that are not covered by the Bank of England paper, but I want to cover this today as well. And this is through the fiscal side. When the government, for example, decides to spend money by borrowing, so that we have this deficit spending, this is also creating money. And the mechanics is quite similar. For example, when the government decides to issue treasuries, for example, here the example is based on the Georgian lari, which this GEL is denoting. And when the government decides to issue treasuries, what this essentially does for the depository institutions balance sheet, or what we call monetary survey, what it does is essentially is increasing the liquid balances of the government and reducing those for these depository institutions. And for example, when the public sector issues treasuries, then if the banks buy these, then banks would have less liquidity, but the treasury would have more liquidity. So here I will be discussing treasuries bought by banks, which is usually how it works in Georgia. We can also have some non-banks buying this, but this is because only a very small part, at least in our case, then this is how I will look at this. And again, what these issuing treasuries does is essentially, in some sense, changing the maturity of the public sector's debt. Public sector issued presumably long-term treasuries and instead mopped up this liquidity, which is short-term. So it's essentially just issuing treasuries in this example, in this balance sheet identities we see, is simply, in some sense, debt management operation, not really a money creation operation. But when the treasury or the government decides to spend this money, this liquidity that the treasury got, it can use this liquidity to transfer to non-banks, to pensioners, to its to companies, to school teachers, and so on. It can use this liquidity to make sure that banks are willing to get this liquidity in exchange of opening up deposit balances for those teachers or pensioners or whoever the government wants to use this money on. So that is the step where the money is created, because liquidity that the government obtained at the first step is actually used to create deposits, which is part of broad money. And this is where money creation works. So if we sum up these two operations, which I call deficit spending, we see that the deficit spending is creating money by creating net domestic assets. So now the question is, does this only work if the government borrows in domestic currency? And the answer is no. If we assume that the government actually borrowed the same amount in laris, for example, in this case, but borrowed in foreign currency from foreign agents. Does this change the picture? Well, it changes the first step of this process, which was, like I said, more like a debt management operation, not really money creation operation. So here again, we have this that is more like debt management operation, meaning that the government, the public sector as a whole, which is government plus the central bank, actually has more foreign exchange debt and less liquidity. So because the way it works is that when the government borrows in foreign exchange, those foreign exchange reserves, FX reserves, goes to the central bank's international reserves, and instead the government gets the domestic currency liquidity in exchange. So it's like a conversion, and that's why I call this, in some sense, debt management operation, swapping some one currency into another currency for the public sector debt. But again, if we look at the second step, which is actually the same in this case, is the government using that liquidity that it got from the central bank in exchange for those FX reserves, and using this liquidity to transfer this liquidity to commercial banks, in exchange of commercial banks opening up deposit balances for those people, like I said, the government wants to spend money on. So if we sum these two operations, again, that's money creation, even though the money is created in exchange for the net foreign assets. So this is not something that the commercial banks themselves can do, because it opens the FX position, because in this case we obtained assets in foreign exchange, but the liabilities, the money is created in domestic currency. But because the central banks accumulate reserves and they can have this open position, that's why in this sense we still got this picture of net foreign assets, net foreign inflow by government borrowing is resulting in money creation. So the conclusion is that in this kind of environment, it's deficit spending that creates money, not necessarily just domestic currency borrowing. It doesn't change, in this example, it doesn't change the picture, whether we borrow in domestic currency or foreign currency, it's still deficit spending that is creating money. So now let me generalize these couple of examples by saying that in most cases, in contemporary monetary economies, money is creating by issuing these kind of specific liabilities, which we call current account deposits or whatever, against usually public debt or more importantly, bank credit. So this is what creates deposits, and this is what we call money supply. But this is the first stage of money supply, because we know that when the new money is created in the form of deposit, then the life does not stop there. It has an afterlife. These new deposits have afterlife. And what this means is that some people may decide to withdraw those deposits to cash out, or banks would need some additional liquidity to satisfy these reserve requirements. So those two are the key channels through which these newly created deposits, whether it's done by banks or government deficit spending, it still creates demand for liquidity. And that's where the central bank comes into play, because liquidity is something that only central banks can create, the actual liquidity in central bank money. And because this is the last step where the demand for central bank money is created, that's why I think in principle, even though the end result can look similar, in principle, the process is that central banks tend at the end of the money creation process, not at the start, contrary to how textbook models like money multiplier would suggest. So obviously, then because this last step is where the central banks come into play, that's the step where the central banks can hope to do something to affect the money creation incentives. And that something is usually through price of liquidity. I'm not sure if that is a very good term. What I mean is, in general, interest rates. I mean, the central bank can affect the interest rates because it's the monopoly supplier of liquidity, and it can set the price of liquidity. But it can also affect some other interest rates. In general, affecting interest rates is its key channel through which it can affect credit extension incentives and therefore money creation incentives. So what textbook models would suggest is essentially a link that goes from here to here, but this is, like I said, not how it works, and it misses key facts of the mechanics. And this, as we will discuss later on, can generate a lot of misconceptions and potentially policy errors. So in effect, in reality, the process is not that simple. Actually, in reality, if the central bank wants to affect money creation in the current monetary frameworks, it has to affect the interest rates and through these hope to affect the credit extension. So obviously, one may say that what if the central bank does not satisfy this demand for liquidity? Does not this lead to banks being forced to internalize this fact that central bank does not always satisfy demand for liquidity, and therefore they will follow this money multiplier approach? So the question is, what happens if the demand for liquidity is not satisfied? One potential situation where this can be true is, according to, for example, Gary Gorton and co-authors and others, if we look at the monetary history, then there was a time when, for example, banks could issue deposits. This was private money, but this was not at par, convertible at par into public money. So this was not how it worked, for example, in this case, back in 19th century. Instead, the idea was that for each bank, the money issued by this bank, by this particular bank, was trading with other types of monies with a flexible exchange rate. In some sense, this was a flexible exchange rate. So if you hold a $1 deposit, it's not, if we try to translate this into our contemporary systems, if you hold $1 deposit and this exchange between deposit and cash was done in a floating exchange rate regime, then you're not sure whether your $1 deposit is equal to $1 cash or not. Sometimes the $1 deposit can be equal to 80 cents or 85 cents. So this price was fluctuating, and this is one way for the central banks to say that I'm not always satisfying demand for liquidity, so that you should be okay with sometimes not being able to transform your deposits into cash. So this is not the best way to have a system working, because those prices fluctuate based on some insider information, like people who have more information about the specific bank. That's why, for example, this Gordon and Weber paper argues that this type of money was not a very good means of payment, because those people who did not have much information about this particular bank's private money were not inclined to use this money, because they knew they would be exploited by those who had more information about this particular bank. So that's why this at par convertibility, making sure that $1 deposit is equal to $1 cash, or sometimes called informationally insensitive liabilities of banks being medium of exchange, that became a major way how monetary systems are set up, so that they are good medium of exchange, so that their price does not change. So everybody has an incentive to participate in this kind of money system. But if you have this kind of system where you promise that $1 deposit is equal to $1 cash, but you still do not satisfy demand for liquidity, then either this generates very high interest rates, or in extreme cases, it can generate this picture, which is bank runs. The bank runs is essentially people's fear that their $1 deposit meant to be equal to $1 cash is now equal to $0 cash, so that they rush to bank to make sure that they are first who withdraw those liquidity from the bank. So that's why this is, of course, an extreme example, and this is something that we do not see frequently, but still, this is an extreme example of liquidity being not being supplied when it's needed the most. So that's why in the contemporary systems, if central banks want to, one, maintain control over interest rates, and two, to make sure that they minimize liquidity risk and therefore minimize these run risks, they are in most countries, they follow this interest rate targeting framework, so that they are in some sense forced to supply liquidity that is demanded at a given interest rate. And this is actually another way to somehow demonstrate how this process actually depends on the trust that liquidity would be enough, so that your $1 deposit is always $1 cash. It's because it's dependent on trust so much. That's why Walter Bagehot said that every banker knows that if he has to prove that he's worthy of credit, in fact, his credit is gone. So that's why it's in current systems, it's about trust. In the money creation process, it's about trust. So that we trust that when banks create those $1 deposits, those will be convertible to cash at par. And the trust guarantor should be a central bank. This is how current frameworks work. And central banks do this guaranteeing by making sure that liquidity risk is low enough. So the higher the trust, the lower is the liquidity risk premium. And this lets banks create money or allocate money more efficiently, but this also creates, in some sense, a moral hazard, because central bank is guaranteeing one risk, and somebody else is using the benefits, fruits of this guarantee. Of course, this is a moral hazard, and that's why we have prudential regulation. Not because banks are trying to steal something, but because there's a moral hazard. Of course, there's nothing ruled out, but the usual argument is this moral hazard. So now let me quickly review again this process. Like I said, if the central bank has to satisfy this demand for liquidity, then deficit spending, credit extension, it creates new deposits. These new deposits create demand for liquidity, and central banks supply this liquidity, but at some price. And this price is the interest rate, the policy rate, and that's through which central banks affect monetary aggregates, if you wish. So how this actually, whether this is a reliable effect from central banks to money creation, that's an issue that is mostly related to monetary transmission mechanism literature, saying that if the central bank changes its policy rate, how much does this affect the these loan interest rates, and therefore loan extension and money creation? And here the transmission mechanism is usually, for example, if we take the expectations hypothesis, saying that the current and future expected policy rates taken average of them is creating a base for longer term interest rates. Then if we add some interest rate risk, what we call term premium, this essentially results in interest rate which is longer term, but it's risk-free in other sense. So just incorporate this term premium. So this is essentially, for example, T-bill rate. Then we can actually have another layer, which is liquidity risk, and we can, for example, arrive at a term deposit rate. So why does this term deposit has a liquidity risk? It in ideal cases should not have, but in some cases it can have if the promise of central banks to supply as much liquidity as necessary is not credible. Because the term deposit is an asset for deposit holder, and it may fear in some cases that there is a small probability that it may not be able to get cash in in return of these deposits. So if this happens, then that's what we call liquidity risk, and that can actually push term deposit rates up. And of course, then we can have some credit risk. We can have some interest rate spreads, which may include things like how much risk banks see in overall macroeconomic environment and so on. Of course, there is this overhead cost and so on, but I didn't include everything. So it's like approximately the picture. The picture is that the central banks changing these policy rates hope to affect these loan rates through this, while other factors can still can also affect these loan rates. So as long as we have this transmission, then we can hope that we are affecting the loan extension incentives and therefore money creation incentives. So this is process, something that I have summarized so far, is something that is usually missing from standard macroeconomic models, standard DSG models. But there are a couple of few exceptions, and one of the exceptions is, like I said, the IMF paper co-authored by Doug. This is a paper that discusses money creation endogenously in otherwise more or less standard DSG model with a somewhat similar bells and whistles. So what this model says is essentially something that many other models like money multiplier models or loanable funds models would miss. And that is the speed at which bank lending can take place, and two, the fact that consumption and investment do not have to always move into opposite directions. In a loanable funds theory, you need this because if you want investment to take place, you need some lending, you need credit. If you need credit, then you need somebody saving. And if somebody's saving, then saving is essentially less consumption, right? And because of this loanable funds theory could show this picture of consumption and investments diverging, but it's not actually how this works. It's not actually how the real world works, and it's counterfactual. In fact, consumption and investment usually follow same paths, and this is something very nicely captured by this model, because this model incorporates the endogenous money creation that is more realistic. So another type of set of misconceptions which I want to quickly touch upon are the following ones, which I think can in principle and sometimes does result in confusion and potentially wrong policy advice and policy errors. So one of the misconceptions which we already actually discussed is like central banks printing money and this being lent out by banks. So this is not, as we already discussed, how this works. In fact, it's bank lending that creates money. And this is something that creates demand for central bank money later on. And another related one is this money multiplier depiction of this multiple loan extension creating broad money in response to central banks printing first this narrow money. But like I said, this is not how it works. This is not how mechanics work. If anything, money is multiplied down mechanically. It's broad money that is created first by lending and creating deposits, and only then we create narrow deposits if those broad money, those deposits being created are cashed out, or if they create demand for liquidity, for example, because of reserve requirements. Another is something we already touched upon on the previous slide, is somebody being forced to save if we want bank lending to be possible. But this is, again, not how it works. Banks do not actually lend real resources. Real resources are something that we indeed need to save by consuming less. It's by definition, investment is by definition output that is not consumed. But banks are not actually intermediating these real resources. they do not lend real resources, they lend financial resources, financial assets, which is for borrower, it's deposit, bank deposit, which acts as a medium of exchange. And those financial assets can be created without prior real saving. Real saving is, like I said, a function of the past. It's like an accumulation of the past work, like investment and capital stock, physical capital stock, for example. But financial assets, they are all about future. They are promises, so that they can be created without prior real saving. Another related misconception is that we may be thinking that when interest rates go up, we should be expecting the volume of deposits to go up as well. So if we look just at savings deposits, this can happen. But if we look at the overall deposits, it won't. And the reasoning is the following. If interest rates increase in the entire economy, this means that interest rates on loans should be increasing as well, which means that in general equilibrium, we should be expecting some reduction in demand for loans. And if less loans are extended, if less credit is extended, then we, on a system-wide level, we would see less deposits, not more. So this is another misconception. And actually, this is sometimes related to, for example, I've seen a couple of papers in the context of central bank digital currencies arguing that if those central bank digital currencies result in higher deposit rates in the system, this will increase the amount of deposits and amount of loans. But this is partly a confusion brought by this money multiplier and this loanable funds approach, which says that the higher interest rates cause more deposits, which in general equilibrium on a system-wide level, they don't. Another one is something that I've heard from non-economists frequently, is that we need bank regulation, prudential authority, or central bank doing this to make sure that banks do not steal our money. But this is actually not how the system works. Why we have this prudential regulation, as we already discussed, it's because of these moral hazard issues. Because banks are given this money creation ability, which is backed by the central bank, and this is creating some incentives that we need supervision and regulation for. It's not just simply stealing money, because stealing money is already a criminal offense. So we don't need some separate authorities, a separate institution for that. Also, there is sometimes a misconception that if banks or capital markets are similar, they both intermediate, that's why they are always in competition. I don't want to say that they are never in competition. They are when it comes to, for example, maturity or risk transformation. Sometimes shadow banks can also do this kind of liquidity transformation, creating informationally insensitive liabilities. But usually, capital markets cannot create money. They intermediate them, but banks do. Banks create money by expanding their balance sheets. And that's a difference. And in this particular side of the system, they're not direct competitors. And these are misconceptions that I wanted to quickly touch upon, but I want to discuss two misconceptions that are particularly interesting for me and in the Georgian context. For example, one question is usually we get is, if no matter how this money creation works, whatever we discussed so far, if we have a central bank that still decides to print more central bank money, supply more liquidity, no matter what happens in the banking system and so on. If the central bank decides to supply more liquidity, doesn't this still result in an increase in broad money? And the answer is no, unless interest rates in the economy are affected. So if interest rates do not change in the economy, if the loan extension does not change, then broad money will be unchanged, assuming that fiscal sector and all those other stuff are unchanged as well. Just central banks printing more liquidity does not in and of itself automatically result in increases in broad money. And the reason is simple. As we already discussed, it's the central banks affecting loan extension, or if they can affect the deficit spending incentives, that creates money. But we can have a situation where central bank is trying to supply more liquidity, it expands its balance sheet, but it's not affecting money supply much. And the reason is quite simple, because those are instances when central banks are already at the effective lower bound. So when the central bank is at the effective lower bound, when interest rates cannot decline anymore, then if you supply more liquidity, and of course, this QE was meant to affect the long-term interest rates, like compressing the term premia and so on. But abstracting from this, if interest rates do not change much, then money creation won't change much as well. So that's what we see on this graph, which is taken from Michigan textbook. When monetary base expanded, but money supply, this money aggregate did not change much. It actually increased slightly, possibly because of interest rates being slightly lower as a result of this QEs and other stuff, but that's just a conjecture. Another example where when the central bank supplying liquidity does not result in changes in the broad money, in the what sometimes is called money supply. Money supply is not affected by central banks providing liquidity if this liquidity supply is a reflection of, for example, demand for cash. The onset of the pandemic was a nice example in this sense. In 2020, in March, April, we saw very big increases in demand for cash. People decided to withdraw money from banks, and that created demand for liquidity from the banks. And even though this liquidity was supplied casually by the Georgian Central Bank, because we operate in an interest rate targeting framework, and if we want to retain control over interbank market rates, so we need to supply this liquidity. But still, even though this liquidity was supplied, banks were still fearing that this liquidity supply may not always follow suit. The fear was that for example, I think that the fear was that they may run out of collateral to obtain liquidity from the central bank. And that was the reason why they actually were forced to increase term deposit rates too much away from the policy rate. And that's essentially this liquidity risk premium that I mentioned a couple of slides earlier. So this is an example where central bank supplying liquidity not only is not generating more broad money automatically, it actually can be an example where this liquidity supply was not enough, so that interest rates increased, and if the central bank in this case had not initiated liquidity provision new instruments, this could have actually resulted in less credit and less broad money, not more. So those two examples of central banks supplying liquidity but not being able to affect interest rates because they are at the effective lower bound, and central banks providing liquidity when there is just simply demand, for example, coming from cash in circulation. Those are instances when central bank increasing supply of liquidity actually has no effect, not much effect on broad money. So to see this more on a mechanical level, we can actually look at the balance sheet of the central bank. So this is in some sense a simplified version of the central bank balance sheet, but still it has the key components, which are on the liability side. The central bank creates this reserve money, which serves two purposes. One is to satisfy the demand for cash, and the other is to satisfy demand for liquid balances, the reserve balances. For example, when banks have to satisfy reserve requirements, they need to hold these kind of reserves. So that's this reserve money is some of these two, and those can only be created if it's in response to obtaining some assets on this central bank balance sheet. So it's an identity. The central bank can't supply liquidity unless it has assets on its balance sheet. So what can be assets? One usually example is foreign exchange reserves. So those are the assets that central banks can buy, and they can accumulate reserves and supply liquidity through this. They can also have net domestic assets, like the governments are having a position, this government position, which is, for example, if the central bank buys some government bonds, or in other examples, if the government buys other type of securities, for example, the advanced country central banks have bought many different kinds of securities during the crisis. The central bank can also provide liquidity against lending. For example, the usual way the Georgian central bank provides liquidity is through refinancing loans, and that's essentially an asset for the central bank against which it supplies those reserve, which is liability for the central bank. So now, again, to come to the to go back to this point of why the demand for central bank liquidity can increase, but this not being a reflection of a change in broad money, we can actually discuss the reasons why central bank liquidity supply may change, even though nothing else is changing. For example, in a nutshell, what we want to make sure that the interbank rates remain close to the policy rate is to make sure that the demand for reserves is satisfied. So in simple terms, if banks have reserve requirements, they need some 100 lari reserve balances, they should be able to get those 100 lari reserve balances somewhere. So where do they get these reserve balances, or whether they lose reserve balances because of some other operation, is what we will be affecting the liquidity supply needs. So for example, these FX interventions can change that. When central banks buy FX, they essentially withdraw liquidity from the banking system, and the banks will be left with less reserves, and therefore they will be forced to find ways to obtain that liquidity somewhere. And if it's on a system-wide level, then it's only the central bank that can satisfy this demand. Then we can have government operations. For example, if government, collects taxes or spends money, this affects the liquidity in the banking system. So recall this example where we discussed how money is created by government's deficit spending. So that deficit spending was essentially creating deposit by banks in exchange of banks getting these liquid balances from the government. So if this is the case, the banks have more reserves. If it's tax collection, then they can have less reserves and so on. So this is something that can actually affect the amount of reserves in the system. Then we can have a change in the in cash. Cash in circulation can change because people may wish to withdraw deposits. For example, if banks have 100 laris of deposits and they are able to satisfy demand for if they are able to satisfy this reserve requirement by a proportionate amount of reserves, if half of those deposits are cashed out, then suddenly banks are out of reserves, and therefore they need some source of liquidity to obtain to make sure that these deposit withdrawals are satisfied. And that's what results in liquidity supply. The need for the central bank to supply liquidity through these other instruments, which is borrowing from the central bank. So this is essentially what we call monetary operations, and the key among them is these refinancing loans, which are essentially credit obtained by commercial banks from the central bank to make sure that they are able to satisfy demand. They are able to satisfy their demand for these bank reserves. So because of these all other types of operations, the central bank can be seen to be providing liquidity through one arm, but this does not mean that it affects the broad money, not at all. So this is something that is sometimes confused, and the reason is that this broad picture is sometimes overlooked, which is that if the central bank does not affect this interest rate, this price of liquidity, it's not affecting credit extension, and therefore it's not affecting money creation. And again, as we discussed mechanically, central banks, through this central bank's balance sheet identity, central bank can be lending more to commercial banks or less, but this does, in case when this is a reflection of change in demand for liquidity, these central bank operations are not affecting interest rates. And if interest rates are not affected, then it doesn't really make much sense to argue that broad money is affected, because it's not, unless interest rates are affected. Okay, so now let me go to the second key misconception that is sometimes, I would say, resulting from this incorrect exposition of how money creation works. And the misconception is that if you have a commercial bank that on the liability side has central bank refinancing loans or other type of borrowing from a central bank, this means that it's the central bank that is funding these operations of this commercial bank. And the question is this the case? Is this the correct way to characterize how the system works? And I would say from an accounting perspective, of course, this is trivially true, but from a macro perspective, it's not a very good characterization of how the system works. And let me discuss one example just to shed some light to what I mean by this macro perspective and central bank being in this macro perspective. Let me discuss another example that is very much related, as we will see, is an example of having two banks and one household, and one we can possibly have another borrower. So here the situation is that we have this household that has deposits at Bank One, but because Bank One couldn't find good borrower, it actually was left with an option to lend out this liquidity to Bank Two through interbank market. And because Bank Two was able to find good borrower, then it was able to extend this loan. So in reality, the process would be in reverse, because Bank Two would be first finding good borrower, extending this loan, but because this Bank Two's borrower may be using this newly created deposit to pay for stuff, seller of which has an account at Bank One, then those newly created deposit by Bank Two would be lost in favor of Bank One. And of course, then Bank Two would be forced to borrow this liquidity from this Bank One on the interbank market. But this doesn't change. The final picture is the following: that household has a deposit at Bank One, but it's Bank Two that is lending to someone, to a borrower. So the question is, who is funding this loan extended by Bank Two? So from an accounting perspective, it's obviously Bank One, because on the balance sheet of Bank Two, it's the interbank loan from Bank One that is sitting there. And I'm not saying this is not important. This is sometimes very important to understand the interlinkages between banks in a financial system. This wholesale funding is not always as stable as retail funding. So this is important, but still this is one perspective. And another perspective is a macro perspective. And on a macro level, I would say that it's still the household that is funding those loans, because Bank One is essentially playing a simple, a true intermediary, just a pass-through funding for Bank Two. Household is willing to hold its equity, hold its wealth in the form of deposits, and this willingness to form your wealth in the form of deposits, because you acknowledge that deposits are good means of saving, that's what's creating this possibility that Bank 2 is able to lend out. So on a macro level, this is, I think, it is trivially true that in accounting term, it's Bank 1 who is funding loans. It's also trivially true that on a macro level, it's household that is funding those loans. And now let's go to this, go back to this question of what happens if we have a central bank instead in the middle. So this is actually quite similar. Actually, it's much more similar than you would expect at first. Actually, if you realize that cash, in a sense, is already a deposit, but at the central bank, then you will see that the picture is essentially the same. Why is this cash the same as deposit? Because both cash and deposits are trading at par. They are one and the same. Most people do not actually even understand what's the difference between cash and deposits. They essentially say that the deposit is banks holding cash for them. Of course, it's not. Cash is a public money, deposit is a private money, but still, just because they are perceived to be the same, underlines the fact that people hold both as an either medium of exchange or means of saving, and therefore they are in a sense the same. Another perspective through which cash and deposit are similar is that they are both liability of a financial institution. Deposit is a liability of a commercial bank, cash is a liability of a central bank. So in this sense, we have a similar picture. Household is willing to hold its equity, its wealth in the form of cash, and then the central bank is passing through this to the Bank 2, and that's where loans can be funded. So again, if we have to ask the same question here, who is funding those loans? Is it the situation that nobody really wants to hold lari deposits, but because we want to have lari loans, it's the central bank that is printing money and funding loans? And the answer is that as long as there is demand for cash, that's what's creating this non-zero balance sheet for a central bank. Because there is demand for cash, that demand for cash is satisfied against this central bank liquidity provision, which in this example is called refinancing loans. And that's why the loans from Bank 2 are possible to be extended. So again, here the difference relative to the previous slide is, the only difference is that we have cash instead of deposit. So again, the answer is similar. In accounting term, of course, it's the central bank that is funding, because it's what we see on the Bank 2's balance sheet. But on a macro level, like before, it's still the household that is funding those loans, because we know that the household in this case is willing to hold its equity in its wealth in the form of cash, and that's what's creating demand for cash, and that's what's creating central bank's ability to supply liquidity and pass through this liquidity to Bank 2, which at the end of the day is funding loans with this demand for cash. Okay, so this is these are just a few misconceptions that I wanted to cover and to expose what can go wrong in the standard textbook exposition of how money creation works. And let me stop here. Of course, there could be some other areas which can actually deserve more discussion, but because we're running out of time, so let me conclude here, and I really look forward to your questions and discussion and comments.